Okay, everybody. Welcome. I'm going to do a quick stream here. I am under the weather like hell. Multiple weeks here catching various viruses. My daughter's school, very fun. But I wanted to do a quick, hopefully quick, follow-up to the money supply videos from earlier this week. So I am going to show you this chart. We talked about this in detail a couple streams back. M1, M2, M3. A reminder, this M3 money, all right, these lighter shaded areas, including this discontinued M3 from the Federal Reserve, the tomato line, takes a long time to parse through and to recreate. So I have recreated it for you. It's pretty original research, I can say, on the web. So enjoy that. We're just looking at liquidity. We're looking at money from various institutions that sloshes around the economy. And maybe we can find some clues as to what might happen in the financial markets. But we have some challenges there, of course, because if you look at the black area, the gray and black area, that is what we call central bank money or Federal Reserve money. Specifically, these two items that are, you see the vault, it says bank reserves and vault cash. That is all the bank money, only money that banks can hold. And the M0, all right, you see it? I'm turning it on and off right now. That is Federal Reserve notes and Treasury coins that the public can interact with. Both of those are part of, you add that up, that's the monetary base. That's the money supply that's analogous to Bitcoin. And if we just look, anywhere here, zoomed in before the global financial crisis, you don't see the monetary base change at all, but you see bank money change. All right. I know I might have just sounded confusing when I said bank money. You see broader money, which is money that banks create on top of central bank money. Okay, so this is the fractional reserve system that we have. And in particular, as I talked about, let's take off this section, which just shows the difference between the repo market in M3 and the large time deposit market and institutional money market fund. This M3 supply right here, which I have calculated, you can see that the delta increases from M2, right? You see it increases up here to 16.5 trillion minus 7, roughly 9, 10 trillion, right? And then here, it's increasing again. So it's a 13, 14 trillion, the delta. Understanding the relative change there, the relative marginal change to show us what risk we are really having is what I'm going to try to show in the next couple slides. All right. So got the same chart here, but I've taken off M2. So in this chart, we had M2, we had variations of M3 with money market funds, so on and so forth. Now we just have the broadest money supply that I've calculated. Note, it does not include euro dollars. But it is pretty rigorous to get you something that we can build multiples out of. Okay. So if we see here, same numbers as of September 2024, 35 trillion roughly in M3, M1, 9.8 trillion, M0, 2.2 trillion, which is the Federal Reserve notes outside of banks. Let's take off the Fed repos. The chart looks better too when I do that. Then we got the monetary base, which is that 2.2 trillion plus the 3.3. And the reason it's negative is because the public cannot hold the bank reserves and the cash. This is just central bank money for banks. The money that is in the positive, all right, to clarify what I said just a second ago, the money that is in the positive axis here, the green shaded money, that is bank money for the public. So there's the pyramid scheme, right? We have central bank money for the banks is in black. And then we have bank money for the public in green. And we do have a slight overlap that central bank money also goes to the public. That's M0. So you got to parse through it. You got to understand it a little bit. But obviously we see it grow. Okay, grows fast. All these money supplies, you're looking at something from 7 to 10% per year, just roughly 7%, 7 to 10% per year compounded, whether it's bank money, whether it's monetary based money, something to keep in mind. But now let's do a quick look at demand deposits divided by these bank reserves. Okay, so where are demand deposits, right? Demand deposits are the most, as the Austrians like to say, the sacred money supply. I do not think that they're sacred, but people like to talk about it that way. It's fine. I'm not saying I'm for risky banking. It's just how banking works. So M1 minus M0 is where you find demand deposits. So you can see, let's take off M3, just make it simple. M1, all right, minus M0 will give you demand deposits. Okay. So where's M0? It's that physical cash and coin. M1 is there. And by the way, M1 is also something I have to sort of backdate and recalculate because the Federal Reserve doesn't even publish M1 anymore. It's basically analogous to M2 because of savings deposits, they say, are very similar to checking deposits. Lots of stuff. It's nonsense to do it that way. They make nothing backwards compatible. Analysis is very difficult, so you have to parse through this stuff. But this is a somewhat backwards compatible M1 money supply after the Federal Reserve started to change the rules in 2020 during COVID. So you see huge stimulus, huge increase in the money supply, which has leveled off. It's leveled off in recent years, but it's still higher. All right, to be clear, 9.8 trillion divided by 5, right, nearly double than it was pre-COVID. And pre-COVID, 5 trillion, that's more than double pre-GFC. Okay, so demand deposits are in the green. So if you subtract, you take the M1, I can't put it all on the tooltip, so you just got to do the math. Or at least I haven't found a clever way to do that. So you have M1, 10 trillion roughly, subtract M0, 2.2 trillion. You're getting something like $7.8 trillion in demand deposits, okay? $8 trillion in the United States. Let's take that $8 trillion and let's divide it by the black in the negative. These are their reserves, okay? This is how the monetary system works. One party has assets. They make loans on the same side of their balance sheet. Actually, they make loans, but they issue liabilities, that is deposits, on the other side of their balance sheet, the liability. That's what these green items are. Okay, so in order to see some leverage of the system, we can run multiples. So how would we do someone like an M1 multiplier, but it's the sacred multiplier. If you're an Austrian, it's demand deposits divided by bank reserves. Okay, so it's M1 minus M0 divided by bank reserves. Let's put this multiple up. It's going to be on the right-hand side now. All right. What we can see pre-GFC is something that it looks kind of wobbly, but if you look at the right-hand axis, it's not too much. All right, in the 80s, you had a multiple of 14x. In 1995, you got to a low of 8x. And then just before the GFC, you got up to about 12x. Okay, I'll take the cursor off so you can see back into the 60s as well. 13, 12, 10, 14. This is the inverse of the reserve ratio. If you read a lot of Austrian papers or articles, you hear the reserve ratio is commonly 10%. That's just a number they put out. It's not actually necessarily that at all, as you can see in this chart. The reserve ratio actually in the United States doesn't even exist since COVID. They completely removed it. Before that, the large banks, the city banks, the Wall Street banks, they had to have a reserve of 10% or more. But the old country banks, the rural banks, they didn't have a reserve ratio at all. And different countries have different ratios. Okay? So thank you, good sir, my Swedish friend. I really appreciate your good words. I've been reading your comments as well, and I'll work on some more videos as well regarding different time scales of the percentile bands for Bitcoin. But anyway, so one thing here, interestingly, all right, and this is why I don't put much faith in the dangers of fractional reserve banking. I put faith in the dangers of central banking, but that's very different from the dangers of fractional reserve banking. Is notice that this is the whole chart in the United States monetary system of those very basic deposits, demand deposits, cash, and it doesn't look crazy, okay? And to be clear, lower is better. Lower is less leverage. So, you know, in the 90s, on the eve of the World Wide Web becoming popular, we were in a very safe place. Only 8x leverage of demand deposits over bank reserves. And again, what is that bank reserve? It's just vault cash if people want to make a run on the bank. And that's a very small component, right? That's like 5% of that multiple. The vast majority of that multiple is just a electronic balance at the Federal Reserve, a ledger entry at the Federal Reserve. It has the same legal statutory requirement. It's analogous. Any bank at any moment could say, hey, Fed, we need more cash over here. Give us cash. And they can swap out their bank reserves for cash. But that's how it works. All right, so notice that even though, yeah, it does like rise as we get towards the GFC, it rises from 8x to 12x. It's not like that was an all-time high. It's not like we necessarily know that was a breaking point. So my point is there's more to what's happening in the system than just the sacred demand deposit, okay? But as they do, Ben Bernanke, with all of his liquidity and his bailouts in 2008, he made the system even more complicated and more unanalogous to the past by putting these massive amounts of reserves into the system, okay? It was a crazy move. It zombified banks, bailed out bad investments from money market funds, hedge funds, and banks. It was a bad move. So now we have this completely unanalogous move of going from, you know, something that makes sense of a reserve ratio, 11x, whatever, for demand deposits, down to almost fully collateralized. Understand that. Theoretically safe, but of course we don't believe it's safe. That's why we like Bitcoin. But it's just a nonsense thing to do. This is just pure zombification. This is zombification of banks, what you see here. So now, instead of being only 10%, right, what's 1 divided by 10 or 1 divided by 11, right, closer to 10% or 9 or 10% reserve ratio, we're at 100% reserve ratio here, post-GFC. It's pretty nuts. We've gotten some of the leverage back. Some of these bank reserves have flown out of the system, but it's not anything to ride home about as far as a celebration or a return to normalcy. All right? It's just not normal banking still. We're only at 2x. Okay, so we have this huge pile of reserves sitting in banks as an asset for banks, and they're not loaning them out. Okay. So that's odd. It's a problem. The Federal Reserve, of course, George Selgin has written about this a lot. The Federal Reserve has discouraged the loaning of these reserves precisely because they were afraid of the inflationary effects, and they started to pay interest. They had started to do something completely abnormal during this period, and I'll show interest rates in a future video, but they started to pay interest on these reserves. So if you're a bank, typically, right, during these periods, right, the Fed funds, I'm looking at the black vault area, the vault cash and the bank reserves. Banks got no interest on those things, typically, back in the day. So that's why they would swap out reserves for other loans, for assets, loans to their depositors. So they would increase the deposit base generally. And by the way, that's not all bad. Okay, this is banking. This is how things scale. Populations grow. Suspend your belief about Bitcoin, which I share for a second. But this is just, banks have always expanded the deposit base this way. It's not abnormal thing. It's not an abnormal thing to do. But clearly clearly, just to make the point, you cannot look at this chart pre-GFC and say, there's something systemically wrong with this. How did all this happen post-GFC? You have to go farther up in the monetary stack. And that's where you see it if you put in M3. You start to see these huge deltas now between M3 and M1 or M3 and M2. That's where you see the issue. And now I can do the total money multiplier, for the economy. And I would take the M3 balance minus M0, because M0 is not a leveraged asset, all right? It's just that's cash in the economy. It's in a grocery store till. It's not a leveraged asset. So I have to subtract M0 from M3. So I take that 34 trillion, 35 trillion minus the 2 trillion, get to something like 32 trillion, then divide it by the bank reserves and the vault cash. We'll get a leveraged total money multiplier for the system. That's going to be in red now. All right, let's take off the demand deposit one, which again is skewed and not helpful anymore. But here we can start to see this was an issue. This was an issue that the Federal Reserve failed to get control of. All right, they failed to get control of it. So if a central bank is supposed to steer the monetary soundness of an economy, they failed here. Right? And it was a long, slow boil. All right, to where this multiplier was very similar to the demand deposit multiplier, still double, all right, back in the 50s and 60s. But it grew and grew and grew. Some Wall Street crashes in the 80s, fell back down in the 90s, and then back up again. .com. On the eve of the global financial crisis, we're at 117 times levered over bank reserves. That is where the problem lied. That is where those mortgage-backed securities were. All that stuff. Okay? But then again, with all the zombification, this multiple is completely unhelpful now. It's just, we're theoretically safe. Remember, lower is better in this multiple, so we must be in happy days, because now this red line is 5x, 6x, 7x. Got to 12x actually on the eve of COVID. So before anything happened with COVID, it got to 12x. And then massive money printing. So what's the point? The point is it's harder and harder every day to see how nonsensical central banking policy gets. Would have been better to stop the party here. Again, I'm a free market guy. I'm not saying these guys know what they're doing, but I'm saying according to their mandate, they do know that. They should control the value of the dollar and the value of unemployment, but they didn't do it. All right. After the .com boom and bust, okay, it went down to here, so there was some cleansing of the system, but then Alan Greenspan pushed those interest rates to all-time lows, pushed up that housing bubble. Paul Krugman said, we need a housing bubble. So look, I'm not a fan of tinkering with the system, but I do think we can make honest assessments of what actually happened in the system and can see that the leverage was not in M1 money at all. It wasn't in M1 money at all. It was in M3 money. So that's that. Now, I also promised, I got a good comment from Ryan, friend of the channel, that he wanted to get a further look at repos, okay? So if I go back to this chart, this includes M2 and M3 now. All right, so M2 money is like retail type, less liquid money, because sometimes it's in time deposits. Less liquid is not the best word. You could say less regulated. It's in money market funds, other things, retail, and then institutional, less regulated money is in M3. Okay? And remember, the Federal Reserve couldn't even calculate it correctly here. It's a long story. I'm not going to do it this video. Don't feel well enough to do that. See the last video for it. Okay? But let's look at the difference between, now I'm going to show, so this is total M3 as I have it without Eurodollars. That's a whole other ball of wax. I'm going to show the difference between large time deposits, money market funds, and repos. That is the difference between those two threes. Okay, so let's take everything else off. I'm gonna drill down on this delta between these two threes, and I'm gonna drill down on the delta, or on what's happening here in the Fed repo section of the Fed's balance sheet, which is, again, these are totals, so you got to do a subtraction here. Okay, so it's if you look at the negative section here, we've got with Fed repos, it's almost like the total balance sheet, 5.7 trillion, minus the bank reserves and vault cash, 3.2. So we're gonna drill down on that $2.5 trillion number. How does that play into the repo market and everything else? Okay, we're gonna do that here. Repo market, repurchase market. What is a repo? Again, basically think of it as a treasury security that trades like cash. All right, you're just sending treasuries around to do other stuff, to long more stuff, to short stuff. It's leverage. It's pure leverage, okay? Because if you think about it, how does a treasury bond work for like a normal investor? You might have, if you're an American, or you can think about this in your own government. It was the thing when I was young to gift treasury bonds to someone. You get a little piece of paper, and it's a treasury bond. Would last like 10 years or 20 years, and they would pay a coupon. Depends, actually. Every 6 months, usually. Sometimes every quarter. I forget, actually, the latest. But they pay coupon payments, and then you'll get your full balance back, which in this case, it's a gift, right, from a relative, let's say. But you get that full balance at the end. That's a treasury bond. An unlevered form of that treasury bond is you just sit there, collects your coupon payments for 20 years, and then at the end of 20 years, you receive your lump sum, and that's it. But as we know, that's not what people want to do. People want to lever up. People want to gamble. People want to take more advantage of assets to do other things. So that's what the repo market is. And it's not really for individuals. This is why it's in M3 money. It's institutional money. So pension funds, hedge funds, they're the ones risking things. And then money market funds also participate in the repo market, but not from necessarily a levered side. They're on the other side of the trade. They're lending out their treasuries. That's how it works with money market funds, primarily. But again, a thing to keep in mind with money, with all types of money, institutional, bank money, whatever, is that money is always a liability. It's a liability. So just quickly, back to this chart. Again, let's just look at the full M3. All right. This is the full stack right here without any other layers. What you see in the black is liability for the Federal Reserve, all right, to the tune of $6 trillion. And you also have to add M0. It's a confusing thing because that swings between retail and institutional. But what you see in the gray and the black is a liability for the Federal Reserve. And what you see in the green is a liability for the banking system, the hedge fund system, the money market fund system, the broker-dealer system, the whole system of the United States. Okay, so it's liabilities upon liabilities is how it works. And the core of the system, this is why the core of the system is analogous to Bitcoin. It's like once you want to go back to the core, once you want to retreat to ultimate safety, you have those bank reserves. That's the core. And that's in the gray. It's actually in the black, but again, bank reserves are a little bit different. So I'm going to try to parse through that now. Okay, so who holds the asset side? Let's focus on let's take this off. Let's focus here now. Let's take off M0. Who holds the asset side of this Federal Reserve liability? All right, I've said it already in this video, but the asset holders of the black area, the bank reserves and the bulk cash, those are banks. Banks hold the asset. But there's this delta here, this additional Fed repos, and they call them reverse repos because that's actually the holder from the asset side is a reverse repo. So who holds those reverse repos? Well, Money market funds, hedge funds at times, but mostly money market funds, sometimes banks. They are primarily, though, money market funds. These are shadow entities, shadow banking entities outside of the banking system. So what you have, in a sense, is the black is money for the banks. The gray is money for non-banks. All right. All of it is distorting. Okay. And you can clearly see here, like normal banking, this really kicked off in 2002, the data. I do have weekly data before. It's very minimal, so it's just not there. But, money for banks was we're talking tens of billions, right? And you would still get hundreds of billions or trillions on the bank liability side. But once they decided to bail everybody out, zombify the place, these tens of billions of bank safety money turned into trillions. Okay. So we're just going to now analyze, remember, the black is money for banks. That has a lot to do with the whole M3 stack. I'm just looking at the repo market now, which is, as the Federal Reserve plays in the repo market, it's the gray section. Okay. So here we go. Repo market. First thing is commercial bank repos. Okay. Commercial bank repos. Now, again, not to toot my own horn, please donate if you like this stuff. You're not going to find parsing through this banking data anywhere else. The Federal Reserve is so opaque about it. They don't even publish bank repos for this period from when they finished publishing the M3 money supply till about 2012 after the financial crisis. Dodd-Frank came through. There's a lot of regulations that get your stuff together, Federal Reserve, publish more data so we can understand it. But still, even when they did it, it's just kind of wild. So they started it for banks, again, here, oddly. And then you have the repo data, which is part of M3, and the old Fed data. Remember, they stopped publishing it here in 2006. Okay. So you have to just regress the difference. It's hilarious. Other analysts have done this. I'm thinking of Mr. Barnett from the old Fed economist from the book. Getting It Wrong is a great book. And I forget the name of his agency. It's the Center for Financial Responsibility, maybe. Very good economist. Anyway, if you want to get really into the math, you can read some of his stuff. But the Federal Reserve didn't publish this. It's unbelievable. So they've only published bank reserves to this effect. And here it's quarterly. Here it's monthly. There you go. But you can see here still, it's not a huge part of the repo market, what the commercial banks actually engage in. And again, this is a liability for them, an asset for someone else, like a money market fund. It's not there. So this is one piece. There are going to be three components of the stack here. What is the group of entities that normally plays in the repo market? Hedge funds, pension funds, money market funds even. So that you have to go to the shadow bank, and that totals here. All right. Now, again, this is a layered chart, so I'm adding it. If you want to just find shadow bank, you got to subtract the commercial bank. Okay. It's like this M1, M2, M3 stuff. So here, for example, before the GFC, we got to 4 trillion shadow bank plus commercial bank. Commercial bank was only, you see, 580 billion. So you subtract. So you got 3.5, just roughly 3.5 trillion shadow bank repos, 500 billion commercial bank repos. That's how the repo market looked. And you can see global financial crisis happened after that. It was a huge spike in repos. Probably had something to do with the financial crisis. Okay. Now we see it fall down drastically here. A lot of liquidations, even though, banks got bailed out in a lot of ways with those bank reserves. And you see here, it's kind of held down almost. It's held down. Why was it held down? How was it held down? And now you see it's growing again. Well, it was held down by the Federal Reserve engaging in that market. So here now, I'm going to go back and show you that delta. It's going to be a liability for the Federal Reserve. They're engaging in repo markets here. All right. So they're buying more repos here. I shouldn't say they're buying. They're engaging in repos. They themselves they have treasuries on their balance sheet. They're passing them through to, say, a money market fund or someone else, and they're paying them additional interest. Okay, so you can look at the repo market rate. That's going to typically be a higher rate than the Fed funds rate or even the interest on reserve rate. And this is money for non-banks, hedge funds, pension funds, money market funds. Okay, so the Federal Reserve got in, and in a big way during COVID, they put a lot of liquidity into the market. Now, the net effect actually is, just like with excess bank reserves, this drains the system of liquidity if this number is large. But what does that really mean? It means that these hedge funds, pension funds that are repoing, they have the option to go to this safe place, this ultimate asset of settlement that is the Federal Reserve, to repo with. It's terrible for banking. It takes it away. It takes that market action away from other players in the market. And if you can just get the Federal Reserve participating in the repo market, paying you a repo rate, which is better than a Treasury rate, if you're a money market fund and want to lend out your precious treasuries, well, then you're going to engage with the Federal Reserve. But it's very distorting. Lots of papers have been written about this from the Fed. It's a huge balance, $2.5 trillion. Now it's going away. They're trying to purge that from the system. And notice how number one goes down. This isn't a stacked chart. Number one goes down. Look at number three go up. See? Number one goes down. Number three goes up. So they've put the liquidity back into the system now. But what did I just say about liquidity? It's pretty high here, post-GFC. 3.5 trillion for shadow bank only, 4 trillion total repo market in the system. Now we're at 6.2 trillion. All right, 6.2 trillion. And if you added you can also add that 800 billion, say the total repo market. The Federal Reserve is also repoing 800 billion. So it's really a $7 trillion repo market. You can do that too. The Federal Reserve should not be playing in this market, but it is. It is. All right, so now the Federal Reserve faces more risk. You're going back to this situation, right? Let's put the multiple of, here. Let's go back to this situation. We're going back to this higher leverage situation, but we're just looking at the repo market here, okay? So let's do some leverage, and I got to end the video. Like I said, not feeling too great today. Let's look at the total, number 3, which is repos, shadow bank repos, and commercial bank repos. Again, these are liabilities for those institutions. And the shadow banks, meaning hedge funds, pension funds primarily. Let's take that liquidity and divide it by the Federal Reserve repo and see how levered we are there. Okay. Interesting. Much higher here, which showed to a GFC. And then we get this distorting effect. All right. Still distorted. Just like we were distorted here with all those bank reserves, we are distorted here with all these repos that the Federal Reserve is engaging in. So not as helpful. We were at 100 times what the Federal Reserve was engaging in here in 2007. And by the way, that they only start the data to like 2002, as you might have seen there if I zoomed in. So Federal Reserve participation increases, the multiple goes down, way down. But now it's going back up. The question is, at what level is that super risky? And again, it's hard to answer because we're at a totally distorted period here, post-GFC. But there's one more metric I can show you to give us a little bit different flavor, and that is, let's take just this total value again, 7 trillion. All right, $7 trillion repo market, 6.3 trillion of which is in the markets, not at the Federal Reserve. All right, so it's more susceptible to inflation. All right, these are just Treasury securities that are being levered up to do more, short, long, whatever. Let's take the repo market and divide it by the federal debt, the total debt. All right, that will give us at least some other picture of where we are. That's going to be a red line here. So now this is a percentage. This isn't a multiple, but it's a percentage, right? I had to keep it all in the same chart. So when you see 0.01x, it's 1%. Okay. So the repo market in total, very small here, very small. all right, as a component of the national debt in the 50s and the 60s. 1%, 2%. People weren't really, Wall Street hadn't figured it out yet. They hadn't figured out the super leverage to try to, again, these are just people that own treasuries. They're collateralizing them. They're posting them as collateral to borrow more money to make more bets. That's what they're doing. Look at what happened here pre-GFC. We got to 50%. The repo market was 50% of total United States Treasury securities outstanding. This is the global financial crisis. This is what was happening. Massive, massive leverage in the system, risky bets, mortgage-backed securities, all that stuff. And now, even though we have a lot of the zombification, and it's harder to make sense of this black multiple, right? Because there's so much Federal Reserve involvement, especially here, post-COVID. Still a decent chunk of the Federal Reserve, of the United States Treasury market. All right, so Treasury market is what, like $35 trillion at the moment? Total liabilities of the government are actually way more, like $45 trillion, but publicly traded securities, Treasury securities, those bonds, whatever that a normal person, like a child would get from their grandparents and hold for 30 years. It used to be, at least. Now Wall Street is getting those every day, sometimes from the Fed, but other times from hedge funds, pension funds, and levering them up more. Sorry, the hedge funds, pension funds are getting them from money market funds, and then they're levering up more. That's usually what happens. So usually it's the hedge funds, the pension funds that are doing the levering, broker dealers as well. So the number is 20%. 20% treasuries, $7 trillion. Right? You add the Federal Reserve portion as well, of course. So we got a $7 trillion repo market today. Of course, this is a slow-moving money supply. It's only as of September. So the Federal Reserve portion, actually, I've seen it last couple months, going to keep going down. Public portion is going to keep going up. 20%. 20% is not nothing. Harder to see maybe the true warning signs, but we are lower than where we were pre-GFC. This one at least makes a little bit more sense, right? Since we still have this public debt market, we have, the world still buys U.S. Treasury bonds. We're at 50% leverage, 45% leverage. That is, again, it just means those treasuries were being levered up more by hedge funds, by pension funds. That's all the repo market is. Lower leverage now, 20%, but still pretty high, still pretty darn high. So that's what I wanted to show. That's the repo market. I'll try to do some more episodes with interest rates, so you can see, say, the Fed's funds rate, which is the rate that banks lend those reserves to each other. That's kind of the core rate of the system. Then the interest on reserve rate, which is a paradoxical rate. Like I said, George Selgin's written a lot about it. This is the rate that restrains banks from lending out these huge reserves, this huge reserve balance. They're restrained from doing that because the Fed pays them interest more than the market, which is counterintuitive. But again, this is what you need to do if you don't want hyperinflation and you also want to bail out banks simultaneously. And how do I finish the thought of what I just said there? And the repo rate. So the repo rate is usually higher than those still, because the repo market is a more risky market, so you would expect a higher return. All of this stuff is short term, by the way. All this stuff is overnight lending, weekly lending. Not all of it, but the vast majority. And the Federal Reserve was just terrible, absolutely terrible at calculating it. So another thing, just to clean this up again and show you. The repos that the Federal Reserve published in M3 before 2006 were only the green ones, only commercial bank repos, but there were way more in the market. Just one example of how opaque the system still is, although Dodd-Frank gave us some of this data that I could work through, even though it's so weird and you have to linearly extrapolate the commercial bank repos, and you have to back into what the shadow bank repos are, and you got the Fed funds repos, and you get this total repo market value of $7 trillion. It's massive. $7 trillion is a lot of money. Right? $7,000 billion. It's a lot of money. It sloshes every day through the system, levering up in search of more yield, more risk. It's 20% of total federal debt at the moment. So where are we? I would say we're not at super risky levels. Not at super risky levels. 22% is not super risky. Half of the Treasury market would be risky. That's where we were in 2007, 2008. But we're not there yet. But it's something to keep an eye on. And it's just to conclude, the repo market is non-bank money at the end of the day. It's shadow bank money. The Federal Reserve still plays in it, which they shouldn't. Right? They play in it here. They provide liquidity for people, which means they take liquidity away from the system, which means they distort the system, all the rest, just like they do with bank reserves. But it is non-bank liquidity. That's what you need to think of. So that's the repo market. $7 trillion, 20% of the federal debt. Hope you guys liked it. Let me know what you think in the comments, and try to talk to you tomorrow. Take care.